This Undictated podcast is brought to you by Futuregrowth. And Zain Wilson from Futuregrowth joins us on, a couple of days before the budget. It's coming up on Wednesday, Zain. No doubt you've done a little bit of your own research into what Nhlanhla Nene might be telling us.
Yeah, definitely. It's obviously important for us, given over the last couple of years since the crisis, South Africa's fiscal metrics have deteriorated quite a bit. But we are relatively positive, I think, looking into this budget. We think the statement that Nene made last October to cut down on fiscal expenditure and also slightly better revenues in personal income tax and VAT should hold up relatively well for this budget. So we're quite positive.
Let's start off with revenues. There are talks or little whispers coming out of SARS that they haven't been as successful because of the change in management and the ructions that are going on there. Are you concerned that this is going to impact the budgeting process this year?
I think with SARS, if you look at SARS compared to what we have globally, they've always had a reputation as being one of the stronger institutions in the country. So obviously it's a concern that there are some kind of rumors on the management and what's going on kind of with political influence in SARS. But for the immediate term, I think we don't think that's going to be a risk. We think the numbers look quite strong, and we think the management as a whole, even excluding certain individuals who've been singled out, should continue to hold up the strong work that SARS has done previously.
Okay, so good news on the revenue side, or relatively good news. We'll get into more detail in a moment. On spending, as you mentioned, in October, the finance minister did say that he was going to try and rein in spending to some degree. Are you expecting more positive sentiments on that side?
Yeah, I think year to date we've seen that spending's at and slightly behind budget, which is good because I think revenue hasn't been on the corporate side as good as they had budgeted and adjusted for in October. So you can actually see the work that's been done on expenditure has been good. The trick is going to be obviously for the next year and for 2014-15, so the current year as well, GDP has come out a lot lower, and so has inflation. So it means that there might require additional expenditure cuts going into 2015-16. If that is the case, I think that Treasury has realized that we've reached a point of almost no return on the fiscal metrics. So I think if they do need to additionally cut back on expenditure or adjust revenues, we expect they will do that.
So taxes look like they might be hiked.
Yes, so there are a couple of different options that I think Treasury has. Obviously what's happened with fuel prices over the past year means that there's a little bit of extra fat from Treasury to use the fuel levy to possibly buffer against lower taxes in other areas and also expenditure. Instead of reining on expenditure, they can use that fuel levy. The other options they have is to kind of hike, obviously, the marginal personal income tax, which is near 40%. And we've looked at some calcs, and if they hike that by 1%, they get more or less about 2.5 billion rand in additional revenues. And then there are a whole lot of other combinations they can make use of. We think they obviously won't be too aggressive in using one metric or one measure, so just hiking individual income tax by, say, 5% to get 12.5 billion rand, which they're targeting, but rather use a combination of incremental hikes on income tax or the highest marginal rate, use the fuel levy because it's created an opportunity, and possibly other options like the capital gains tax or dividend tax as well.
Just on those two, capital gains and dividends, given that 12.5 billion is the target number that we're looking at, how much do you think is going to be required from those sources?
So those two are obviously much smaller. Something like, I'd say about 75% of the revenue intake comes from corporate income tax, personal income tax, and VAT. So the additional kind of gains you get from capital gains tax and dividends tax would be quite small. The numbers we've looked at, so you'd get about 1 billion rand from the 2% on the capital gains tax side, and just over 1.5 or 1% increase in dividend tax. So we don't think a majority of the revenue adjustments will come from there, but it will allow Treasury to use other factors and not just hike through individual income taxes alone or the fuel levy alone. So it's going to be a combination of different hikes, we think.
All right, so if we take capital gains and dividends, that's 2.5 billion. For every 1 percentage point increase in the marginal income tax rate is another 2.5 billion. So are you expecting maybe 2 percentage points there on marginal income tax?
possibly 2, so 2 would give you 5 billion, and then the capital gains and dividends tax gives you another 2.5 combined. But then there's a huge chunk that you can get from the fuel levy. So fuel levy by itself, you get 2 billion from a 10% increase, and we've had
or 10 cents
fuel price come down by about 4 rand or just over 4 rand. So you have the option of Treasury getting possibly 35 cents to 50 cents increases in the fuel levy. If you get a 50 cents, you get 10 billion rand by itself. So they can take quite a large chunk of that out of the fuel levy.
It's interesting. Are those the three then that you're expecting to see the combination from? Perhaps 2% on the marginal income tax with your 5 capital gains and dividends, 7.5 fuel levy, even say 20 cents would be sufficient then to close the gap that we spoke about at the beginning.
Yes, the other one that a lot of other analysts have talked about or looked at is VAT. But VAT, I think, is politically a little bit more difficult. And what makes it easier to hike the marginal rate on individual income tax and capital gains tax is that it fits in with the redistribution kind of mandate that Treasury has and that the ANC is pushing. So it makes a lot more sense politically. That we think could be used maybe in a year or 2 years' time to help fund something like NHI. But between individual capital gains tax and fuel levy, we think a majority of the 12 billion will come from those three this year.
Zain, if that 12.5 billion is raised in the way that you've anticipated it, do you think there's going to be negative kickback from business in particular and maybe high net worth individuals?
That's always the risk. I think not so much business because it's not directly going into company income tax, and our corporate taxes are relatively low compared to the rest of the world and relatively low compared to Africa and emerging markets. But obviously, the more you squeeze out that top marginal tax or that individual income tax, the more likely you are to start to see those individuals leaving the country, and we have obviously a skills problem at the same time. So there's a cap on what Treasury can do. You don't want to get into a position where we're progressively hiking taxes and squeezing out high-skilled labor. At the same time, it's obviously going to have a knock-on effect on growth. The risk for us going into the next 4 years is that GDP growth doesn't look amazing, averaging probably somewhere between 1.5% to 2.5%, depending on what Eskom does. And if we don't manage to kick that up, which is going to be the ultimate driver of fiscal consolidation, then we get stuck in a position where GDP growth is slack, taxes get hiked, and that pulls back further on GDP growth.
So at the moment,
it's a 3-year, 4-year problem, not a 2015, 2016 problem.
Exactly, and that's, I suppose, the point is that at the moment there is still capacity, there's still breathing space. But if the economy doesn't start playing ball, well, in a few years' time, there's not going to be that breathing space left.
Exactly. So Treasury, I think, has realized this, and another really important thing to come out of the budget will be how much we're starting to see the NDP being implemented, because there's been a lot of talk over the last 2 years, but we're at the point now where you're not going to have government supporting wage growth as much, you're not going to have government supporting employment, and with the absence of private sector starting to kind of prop up support for growth and employment, we could very easily get stuck in a low growth trap.
Every year in the budget, there's some surprise. Something comes out of left field that nobody has really predicted. If you put on your lateral thinking hat, where might it be this time?
I think the surprise we might have is hopefully not a surprise, but something we're hoping to hear more detail about, because there's been a lack of communication, is what exactly the plan for nuclear implementation is and what the funding plan is going to be, because that's one of two big worries we have on the medium term, is how do we fund nuclear, and secondly, how do we fund NHI. So that's what we've kind of pegged at the back of our mind, that VAT increases will be kept for in 2, 3, 4, 5 years' time to fund those two. And probably the other thing that would be interesting to see is if Treasury announces a set of fiscal rules, because that's been the transition that we've seen globally, is especially in the developed world, you're starting to see those economies that have had a worsening of their fiscal metrics moving towards announcing fiscal rules to help, I guess, alleviate some of the stress. So hopefully we'll see something like that coming from Treasury.
What do you mean by fiscal rules?
Maybe, so what I mean would be a more stringent cap on where our debt to GDP ratio can go, Also how we can fund, so more stringent caps on how we fund from an ILB or nominal side, as well as maybe targeting, sorry, just give me a second, a fiscal surplus or a primary surplus on the fiscal side. So some combination of those three, which give rating agencies in particular a bit more confidence about Treasury and government's ability to rein in any deterioration we might see, or a bit more confidence on a medium-term kind of trajectory.
Good stuff. Zain Wilson is with Futuregrowth, and this undictated special podcast was brought to you by